Meters Mining Weekly is interviewing Trevor Raymond, the Director of Research of the World Platinum Investment Council. Trevor, the World Platinum Investment Council today publishes its Platinum Quarterly. What, in your view, should be the main takeaway from this 30-page document?
I suppose the key takeaway is probably not evident if you look at the document, and I'd say that is the fact that platinum remains significantly undervalued. You're right, it's quite daunting that it is a 30-page report, but what we do is we provide a quarterly supply-demand balance and an annual supply-demand balance that we update 4 times a year. So obviously we're updating this to the second quarter, the end of June. We do have a big break in the Northern Hemisphere for holidays, and that's what we're publishing today. So why I say that platinum remains undervalued is that we've got a situation where the opportunities for platinum look good. Supply is expected to be down by 8% this year. We've had jewelry and industrial very sort of strong, very robust under the circumstances, and automotive particularly strong. If you look at the automotive demand, despite all the headwinds that we've seen in the global market regarding economic growth and inflation, we've actually got automotive demand higher than it was in 2019. And that's largely to do with loadings and some substitution for palladium. So you've got this very interesting supply-demand balance, yet we have a price that remains almost range-bound and looks pretty weak. And that's largely due to metal that's flowed out of both ETF holdings and exchange stocks. And those are for slightly different reasons. And I have no doubt some of those ETF holders have sold their ETFs because they've seen this price just not respond to what looks very, very interesting. So I think the undervaluation is the thing that stands out, and we try to unpack the issues, and hopefully that's very helpful. The report is to your readers, Martin.
And high platinum release rates have persisted throughout 2022. What does this indicate?
Actually, I suppose that's the rub, Martin, is that we've got this unusual situation. I mean, when we spoke in May, we were forecasting a surplus for 2022 of about 627,000 ounces. Today's report, we're forecasting a surplus of nearly 1 million ounces, 974,000 ounces. Yet, we've got a lease rate in the market that is ridiculously high. We know that when there's unavailability of platinum in the spot market, more people are forced to lease metal, and that puts pressure on the lease rate. And in May this year, we saw the lease rate higher than it was even at the peak of the pandemic, when understandably you could almost very, very difficult to get metal anyway. So we've got this very high lease rate and then a sustained rate. I mean, it's still above 4%. That might not sound like a lot, but for the 10, 12 years before COVID, that rate sat at about 0.1 to 0.5% in the market. Obviously, financing costs would be added to that between counterparties. But you've got a rate that is 4 or 5 times what the historic norm is. And the real reason for that is that there's been huge imports of platinum that has gone into China. Last year, we saw that China imported an extra 1.2 million ounces above their identified demand. And if we project the Q2 surge, it looks like the same thing will happen. And that'll almost entirely absorb the surplus that we're publishing. So it is a bit of a paradox here. You've got an indication that there's tightness in the market, extreme tightness, yet we're publishing a surplus. And I think what it is part of that metal going into China certainly is of a speculative nature. People that understand this market see the point I raised in your first question, the fact that platinum's undervalued. They're prepared to increase their stock holdings. But we also do believe a lot of that metal is being used either in industrial applications or certainly in higher loadings on heavy-duty trucks. So I think that lease rate does tell a lot about what's currently going on in the market, Martin.
And to what extent is constrained mine supply and recycle supply adding to platinum supply risk?
So yes, I think it's been a bit unusual over the last few years. We had obviously COVID reduced supply from South Africa, but at the same time we had a metallurgical lockup, the Anglo converter plant, and that took a lot of material out, and that all basically came back into the market last year. So there was quite a high flow of platinum from supply, and there was an assumption in the market that because the high palladium and rhodium prices fantastic dividends have been paid by all of the platinum group metal mining companies in South Africa. I suppose to the untrained eye or the lay reader, the assumption was, well, the earnings are great, they're producing more metal. That ended at the end of last year. So we've got 2022 supply significantly down on 21 by about 8%, largely because of that release of metal in the last period. But if you actually have a look at our quarterly number, the quarter two was actually quite strong. And I think that's, Martin, that there's been some severe pressure on the electrical grid in South Africa. But that only really started happening to the latter part of the quarter that we're reporting on. So I think since then, electricity concerns have been quite high, labor shortages certainly. So it's not that easy. So supply is certainly, from a mining point of view, constrained. And then the second point you mentioned is recycle. And what we know there is that there's been a lack of availability of new cars globally. The automakers have just been unable to produce enough cars to meet consumer demand. And what that's meant is that people have had to keep their cars longer. We've seen the price of second-hand cars go up by as much as 40% in the US market particularly. So because people are hanging onto their cars longer, there's fewer end-of-life vehicles being scrapped. And because the vehicles don't get scrapped, those scrapped autocatalysts don't find their way to the recycle supply. So that recycle supply is down 20% year on year, quite significantly, and not expected to recover anytime soon. The automakers are still having quite a tough time to get out of it. So both mining supply and certainly recycled supply are constrained, certainly for the next few years.
And what are Europe's Russian gas cuts and the US's Inflation Reduction Act poised to do for platinum demand?
Well, yeah, I think those are fascinating developments. I think what we saw already when we last spoke was that Europe was extremely concerned about the importing of Russian gas and the purchasing of that gas funding the war in Ukraine. So what Europe's undertaken is to replace 20 billion cubic meters of natural gas using green hydrogen. The big focus on that is energy independence and reducing reliance on Russia. But what that's done is it's said that they need to generate more green hydrogen, and PEM or platinum-based electrolyzers is ideal to do that. The platinum electrolyzer is more suited to solar and wind because it can adapt to the changes. The other technology, alkaline, certainly prefers a fixed load. So that boost, firstly in Europe to produce more green hydrogen means more platinum going into platinum-based electrolyzers. And the other thing is that it makes more green hydrogen available for fuel cell vehicles. And then most recently, the Inflation Reduction Act in the US, most people are calling it a climate act because a large chunk of that funding is purely aimed at addressing climate change. That also means that there'll be significantly more green hydrogen. In fact, in the US, there's up to a $2 per kilogram rebate on producing green hydrogen. And that changes the game considerably, because suddenly green hydrogen is more attractive, definitely, than grey hydrogen, and actually in terms more attractive than fossil fuels. So we think that these two significant funding sources from two major economies will result in a lot more green hydrogen being available. And certainly that spills over into that availability, meaning the application of more fuel cell vehicles. And Martin, that's likely to be fuel cell trucks in the first instance. They certainly are poised and ready to do that. So both very good news for platinum being seen by a lot of investors for its essential role in unlocking the use of hydrogen to decarbonize. And a lot of investors that we've engaged over the last 8 years and encouraged to look at this asset are now seeing that that connection is right, but then looking at demand growth and constrained supply as a good reason to increase investment in platinum.
And Trevor, there are concerns in the market that rising inflation and declining economic growth will reduce demand for consumer goods and in particular motor vehicles. Does this mean that demand for platinum used in car catalysts will fall? And should investors be concerned?
Actually, that's a great question, Martin. I think you're quite right. I think people are assuming the global economic growth is down, inflation is up, interest rates are up, particularly in the US. People aren't going to buy cars. So because they're not going to buy cars, that automatically assumes that in the US, obviously, there'll be less demand for palladium, Obviously, with substitution, it impacts platinum more than it used to. And certainly in Europe, if people aren't buying cars, that should mean fewer cars produced and less platinum. So that is a logical assumption. The interesting thing is what we've had for the last 2 years is the significant difficulties in the automaker camp. Firstly, the semiconductor chip shortage that occurred, and then in general, supply chain shortages. So the automakers haven't been able to make enough new cars to meet consumer demand. They've also drawn down their stock levels horribly. So while we believe that certainly the inflation and economic outlook will reduce consumer purchasing power, and certainly consumers will struggle more to buy new cars, the amount of that production is unlikely to get even as low as the level that the automakers can actually produce at. So it's an impact, but in terms of our forecast platinum demand, it actually doesn't impact the platinum demand because the automakers are going to make as many cars as they possibly can, and they probably still won't meet demand, even though that demand is lower. So it's a logical thing. And I think that sentiment about just general poor economy, less vehicles, less platinum, has added to the fact that the platinum price has been range bound as this metal has flowed out of ETFs, partly on the back of this type of sentiment. And certainly the exchange stocks reflect in our data as negative investment demand. But those exchange stocks have moved. I mean, we've had 500,000 ounces that have come out of New York stocks that have come to London and Zurich that have then been exported into China. So that metal's unavailable and certainly has been a source of supply. So that sort of explains why the price has been weak. But again, the assumption might just be poor economies, poor platinum. So hopefully our data helps unpack that. And you can see that the strong automotive demand certainly is counterintuitive. And yeah, certainly hope that helps, Martin.
That was Creamer Media's Mining Weekly, speaking to Trevor Raymond, the Director of Research of the World Platinum Investment Council.